Hello, folks. Good afternoon. This is Sanjay Mehta, founder and partner at 100x.vc. Today we would be doing a master class on raising your first check and decoding term sheet. This session is for seed stage entrepreneurs who are looking to raise their first check, and how what are the instruments, how do you raise your first check from investors, understand what iSAFE is about, and what are the do's and don'ts while you are raising your first check. So we'll start soon in a couple of minutes on this. While we are at this, hope all of you founders are uh, safe at home, your team, everybody is safe. Coming to what 100x.vc does across is, we are a first check investor into any startup. We are an institutional fund, SEBI registered fund. We did our class one investment with 20 startups, investing into in last December 2019, and we are looking to invest more into other startups who are raising their first check, institutional check, with us. So if you have an idea, a proposal which you need to send, you can write to us at pitch@100x.vc. Now let's start across the presentation and move forward on the masterclass. The whole thesis of 100x is to simplify funding. The reason why we started this 100x is we thought that there's huge amount of starvation happening across at first check. Seed stage startup founders are starved of capital. They need a lot of helping. The ideas are fragile. They need to ensure that the right ideas are getting nurtured and investments are done across. So that's where we started with the mission to simplify funding, kind of. Now let's get into you as a founder and a startup. First and foremost, you need to understand, saying that what is the reason for your company, what is the mission, what are you trying to solve across, what is the value proposition, what is the elevator pitch, so what is your ask. So you need to work backwards in terms of your first value proposition, in terms of what is the reason, why do you exist even, right? What big problem you are trying to solve. If you are looking to raise venture capital, then your opportunity has to be large enough, a sizable one, where you are able to create an impact. So what is that impact, right? What is the reason for this company which you are building across? Next, we believe an entrepreneur knows how to work in adversity. You chose entrepreneurship because you want to engage in the ambiguous situation, the unknowns, where you are able to work without predictability, right? So who is an entrepreneur? Is somebody who takes a decisions and make it right, kind of. Now, do you have that mindset? Do you have that irrational perseverance to ensure that, how do you build company? Now today, this crisis situation which we are seeing across, do you have a mindset to overcome it? Do you have that possibilities which you work across, where your opportunity to pivot is there, where you are able to control your cost, grow at a pace, at a reasonable pace. So idea is, who is an entrepreneur is somebody who has an mindset or a bend of mind to overcome all obstacles. Now those are the traits which you need to see within you, yourself, and the team. Next is, imagine where you could be. What is the potential market size? What is the addressable opportunity? How large is that? The positioning and the segmentation. What silver you will own across. The market size has to be very, very large. The first thing which attracts any investor is how big the problem you are solving. What is the addressable market size? If it is a very small market size, there is no returns for investors to fund into it. So typically, any problems which, if you see across, which attracts venture capital, would have large market size, or those market size are rapidly growing across. So that's where the whole engagement happens across, right? So you need to decide first and arrive at market size, your own addressable opportunity. Well, let's say market is huge, but what is that So let's say you are working in a location or one segment or one side of the product which you are solving. So what's your current focus and what's the positioning and the segmentation which you will have across? Why do people, so these are the questions which you should be able to answer first to yourself, so that whenever you meet a VC or an investor, you are able to articulate your pitch in a much better way. Like, so for example, why do people want this product more than any other product in the market, right? What is it so unique about it? Is this a painkiller or a vitamin, right? Typically any painkiller will have huge uptake, right? It's quick to adopt. People, it is solving a problem which people have huge need across. So painkillers are typically attracted to a lot of venture investing. Is this a need to have, nice to have? Does this feel a vacuum which is there? Do you have that non-linear growth, the virality with velocity? Every VC gets attracted to a hyper velocity or exponential growth. Now, that's the whole key and function of a venture funded startup, right? Non-linear growth. A linear growth is like a services company. Let's say you are trying to build a website for so many customers, and you have an opportunity to build a great business, but it's a bootstrap business. Number of people you will add will be number of sites which you can build across. But let's say you build a great software IP where users can build website by themselves. Now that's a great IP because there is no correlation in terms of number of customers to number of people. Now you can have a non-linear exponential growth, right? So virality with velocity is something what an investors get attracted to. Entrepreneurs build wealth, not income. So many times in the business plans where founders put up their founder salary at seed stage is a big red flag for most of the investors, and rightfully so. In these times, you have seen across founders taking a big hit on their salary, trying to work and conserve cash. So anybody in their business plan trying to work across to create an income out of the venture investing at seed stage is a red flag. So you as a founder has to have a skin in the game. Try to use the venture capital being invested to build business, not to take home. Kind of that's the key basic. Yes, all investors understand that you have a home to run. You have to have your expenses done across. So anything reasonable works across. But just think across. You as an entrepreneur, you own 100% of the company before investor came in, and at that point in time you hardly were taking any salaries. Now an investor comes in, he puts in money, he puts a value, takes a small stake, maybe 10, 15%, 20% kind of stuff. You own 80% of the business. Now the business is, let's say, valued at 10 crore rupees. So idea here is you got a valuation of 10 crore, out of which that 80% of the business is owned by you. Now with that, you also want an income, which means you want to take that investment money which has come into your company and take it across at home as a salary. Now somewhere your focus has to be in terms of using the cash to build the company, and that's where investors look at skin in the game. Why is this the right time to build the startup? See, timing is so crucial. It's so important for anything to be successful, right? What is that this is the right time to build any startup? Are the situation conducive enough to build this business, right? So economic impetus, right? So what are the better ways of doing things? Is there any new technology thing which has changed the stuff, like how cloud and mobility changed the better way of doing things as an enabling technology, right? Or cultural acceptance, right? Reprogramming of consumer behavior. Like today, we are seeing huge reprogramming of consumer behavior with work from home, remote engagements. Now, all these things, if you are able to leverage and build something out of it, so timing becomes very important. To build any of the startups, right? I was part of the dot-com era. Personally, I built a software as an online accounting software in 99 2000, and it was ahead of time, right? Because the internet itself was on a baud rate, not working out. So focus has to be in terms of why is this right time to build the company, right? Understand where you are now, right? What are the metrics? How do you measure traction? uh, all your metrics which you are going to showcase to investors, keep it ready. What are your MRR? What is your CAC, cost of customer acquisition? How much capital or funds you would need to scale? Just break it out into couple of tranches, saying that okay, first I would like to have couple of lakhs and then I would scale. So basically go through the whole planning in terms of how much funds you will need to scale. uh, Teams, right? What are your competency gaps? Like which are the first hires you would do across? Do you have any gaps, right? So work on your own, understanding your own landscape, right, where you are right now. One of the big question which works across with many of the VCs is, why isn't everyone working on it, right? Who is the competition in the landscape, right? What is your unfair advantage? What is your mode? What is the disruption? What are the entry barriers which you have, right? So these are the things which you need to dig down. You as an founder who needs to showcase a right to win, right? What does a right to win means you know the market better than anyone else. we I mean, as an investor, we invest in multiple portfolio companies. We are not experts in that same field, but yes, we know to identify and work with those founders who can showcase their expertise, their domain knowledge. So once you as a founder are able to articulate that you have a right to win against the competition, you have that unfair advantage. What is your moat, right? What makes you so special that you will race ahead of the competition, right? And if nobody is working on it, then you are not the only one, right? There has to be people who are solving that problem in some way. Never say you don't have any competition. Today it might be not be automated as the way you are doing, but there is some way the tasks are getting fulfilled. So position that how better you are. That showcasing will work across for investors. Next is, why will you do better than established incumbents, right? So what is it that makes you so special against the large big players? Why would Google not come and do it, or Amazon would not do it, right? What is that you will do better? What is that one laser focus? What are your execution plans, right? Monthly rolling business plan, your delivery, go to market, your knowledge about the local information on ground. What is your distribution and sales channel? Is there specific partnerships which you have? So just highlight and work on why would you be better than anybody else in the industry, right? Why would big boys not do the same job as what you are trying to do across? Coming to 100x investment thesis, right? What do we look at? We look at founding team. I mean, as usual, founding team comes across the right to win. What is your expertise? Why are you building this company, right? So founding team is one thing which we very closely look at. What is the market size opportunity? Is this large enough? What is the business model strength? Do you have that capabilities to make profit, right? What are the margins, right? What is your business model? What's your go to market? What is your unfair advantage? What's the moat? Why would people or other startups would not get into it? Or why you have a lead time in comparison to other startups? And we would need to have a conviction of minimum 20x return. Please understand, all investors are investing across to get a return, right? There is going to be a potential exit. So you need to start thinking from an investor mindset, right? Wear that thinking hat of an investor. Why would he invest, right? If you were an investor, why would you invest into that company, right? So a conviction of 20x return, because we as an 100x come first check, and we have the highest risk because this is the space where the founders are still trying to figure out the product market fit. So we come very early, first check, where ideas are fragile. We work as an operator VC. We are not just a VC, we work an operator VC, because we work with founders to build their companies, work with their goals, help them raise the next round. So there's huge work which we engage across with our investments. This is our class one, which we had showcased across. So in case if you got ideas, please write to us at pitch@100x.vc. How do you create an investment, right? iSAFE. This is the most favorable instrument. We as 100x worked across on iSAFE, brought it to India. It is called India Safe Agreement for Future Equity. It's just helps you set your valuations for future when you have got enough data and traction, right? So idea is iSAFE is the best instrument for any seed stage or first check which you are trying to raise. So we tell most of the founders, even if they are not funded by us, we say that valuations, please defer it across for a later stage when you are successful, right? So no price round at seed stage, right? At later stage, you can build a price round where you can have a shareholder agreement, where you have got rights and all those stuff. So iSafe such a favorable instrument which gives a lot of founder friendliness to startups at the seed stage. So I'll take you through that in terms of the comparison on SHA side. What are the things when VCs take objections, right? You got an opportunity, you pitched to a VC. Now, in understand that in VC pitch meetings, if you don't see objections, basically no one is interested to engage. But if there is objections, if there are questions, which means the investor wants to know more about it. Now, our understanding, it takes that it takes minimum 7 meetings with a VC to close an investment deal, and typically if you have not crossed that bar, chances of you to raise money or get a term sheet is typically challenging, right? And if your questions are around market size, then VCs believe that you can't scale. If there are talks about the business model, then unit economics, the pricing ability to make profits is challenging. If there are objections around your go to market, your strategy or of customer acquisition, then VCs don't believe in your execution plan, so you need to work on that. Queries around competition, which means that you as a founder, still there are doubts about your ability to raise the next round with, you don't have a moat kind of stuff. Lastly, if there is a lot of information which is asked on the product side, they don't see product market readiness, kind of stuff. So after every pitch, my recommendation is you should analyze the questions which are asked by VCs, what were the objections, recalibrate your pitch, get more data, more information, tweak your business plan, right? And the engagement has to be a term sheet is a logical outcome, right? Where investors now is able to trust you on your idea, and it stops doubting your success. So I'm just sharing couple of examples of iSafe, couple of so outside of 100x, we have made iSafe investment document public. It's an open source document. You can go to 100x.vc website, download it and use it across. So these are a couple of examples where founders outside of our 100x VC portfolio have also been benefited with iSafe. We estimate that over 100 plus founders have been impacted due to the iSafe use of iSafe, where they saved on legal costs, they saved on the quick closures, kind of saved on time because of quick closure and money in the bank, and also deferred the valuation, which is in best interest of founders. Term sheet and iSafe. Let's try to understand what is a term sheet. Term sheet is just a letter of intent, right? This is where the focus of the on the deal from the investor is maximum when being signed, right? This is where you have maximum attention from the investor, because it's a letter of intent which is not a promise or a binding where investor is saying that I will invest, but it's a letter of intent where more due diligence and more discussions will happen on the business plan, and then the VCs will invest into the company. So term sheet is the starting point where you do a handshake between the investors and founders, right? So legality of a term sheet is just a contract which outlines the brief, key terms, what are there, what would be entailed in that agreement, binding, non-binding, confidentiality, exclusivity. A lot of those terms would be, built within that. It does not have any representation of a legal promise to invest. So never consider this as a mistake, saying that once the term sheet is there, let's try and blow up all the money, and money will definitely come into the bank. Chances of that are 50% of the term sheets don't get converted into shareholder agreement. So at least half of them fall through because what would have been presented by the startup founder, there would be gaps, and investors find those gaps and in the DD, and then they walk away. Or there is a market change scenario which happens across, and VCs walk away from term sheets. So there are multiple reasons why term sheets fall away. Understanding valuation. So valuations is basically will determine how much you will give equity stake of your company to raise the money or amount what you want to take across. Pre and post money valuation. Pre money is the valuation of your business before the investment round. Post money value of your business is after an investment round. So just understand this pre and post kind of stuff. Let me just help you with a valuation math example. Let's say a founder owns 100% of the company. Now founder and investor both agree to value the company at 10 crore. Investor agrees to invest 2.5 crore. Now this is agreement which has been done. 2.5 crore will be invested at the valuation of 10 crore. Now, if the 10 crore valuation is pre-money, then the post-money valuation becomes 12.5 crore. So the equity ownership now is 80% with the founder and 20% with the investor. But if the 10 crore valuation is post-money, and then the pre-money becomes as 7.5 crore. So the equity ownership now is 75% with the founder and 25% with the investor. So post money and pre money valuation changes everything for the equity ownership, both for investors and founders. So please understand, whenever there is an offer being made across saying that, okay, we value your company at 10 crore and we will invest 2.5 crore, please ask the investor whether it's pre money or post money, right? So that sets quite a lot of context kind of stuff. Investment document types, which is shareholder agreements, SHA, convertible notes, and iSAFE. So running this, these are the three document on which you can raise your first check, right? Couple of terms which you should know in a term sheet is liquidation preference. So basically, when founders ask a lot of aggressive valuation, so let's say right now you are asking across, let's say 30 crore valuation. Now with that aggressive valuation in the market, how does investor protect the downside? So it is a promise where an founder gives to an investor saying that, okay, I will give you minimum 2x return on your capital or 3x return on your capital. So liquidation preference is 3x. So whenever there is an liquidation event happening, like a merger or a sale of a company, at that point in time, first the investor will get its liquidation preference, which means that 2x or 3x, which has been promised across by the founder, that money will be guaranteed to the VC, and the balance will be split as per the equity percentage. But idea is at the seed stage, typically it is 1x liquidation preference, which has been in most of the shareholder agreement. Next is drag along, tag along terms, right? So drag along rights are the provision which enables investors, to force founders to join a sale. Let's say an investor has invested into a company, it is 3 to 5 years. Now he wants an exit. Founders is not looking across to give an exit. So investor will find a buyer who will be happy to acquire the company, and founders will be forced to sell that company, right? So that's a drag along right. Tag along rights are used to ensure that investor is considered during a company sale. Like for example, if founder wants to sell across his shares and exit his company, he has to ensure that the investor shares are also equity stake is also being sold across. Anti-dilution right. This provides investor protection in case of lower valuation. So for example, if you have raised your company valuation at 20 crore, and now your next round is happening at 15 crore, so you will have to give additional shares to the old investors to ensure that this anti-dilution rights are being maintained across. So these are specific terms which are there part of the shareholder agreements. Other terms are information rights, ROFR, right of first refusal. So you will have to go to the existing investors before you go out and raise money from other investors. Preemptive pro rata investing right, affirmative rights, ESOP pool formation, which is there, board composition, who will have how many board seats, vesting of shares, tranches, milestones, captive. So these are various stuff which would be written in the shareholder agreements. Whereas in iSafe, the advantage what we see across is one, you don't have any of these rights going into iSafes. One biggest advantage is you don't need to create ESOP pool right now upfront. So you save that equity part of it. You are not part of any of these terms which are there, no liquidation. All those things are already taken care in the shareholder agreement. So at the seed stage, it's not required because you are very early, just starting off the business. So iSafe is just a simple agreement, 6-pager, which you can download from 100x VC website. It is not a debt instrument, a founder-friendly convertible security note that is beneficial for both startup and investors. And to comply with Indian law, it is just a form of a CCPH, which converts at a specified event. So what we do is we use iSafe and just give a cumulative non-cumulative dividend of 0.001%. So like a convertible note where it is a loan on a book for any founder, this is not considered as a loan to the founder. So it's much more safer for founders to you raise money through iSafe. Now these are just a comparison table in terms of how iSafe works across vis-a-vis standard SHA terms, right? On post-money valuation, all clauses which are there in the term sheet, which I discussed across. No, in iSafe there are no rights which are given to investors. It is decided later at the equity pricing round, right? No board seats are being asked on iSafe. No shareholder agreement, just a simple 6-pager. No consent right. No need to create ESOP pool. It's such a simple way of closing a deal, right? In terms of no voting rights to investors, no employment agreement with the founder, no consent, no exit rights. We don't even at iSafe, we don't even control founders' remuneration kind of stuff. No non-compete, non-commitment clause. So every other clauses are removed. It's just a simple agreement, right, which gives a right to investors to just invest small amount of capital for whenever the company raises a future, they have a right to the equity. It is as simple as that, and it works beautifully. We have invested in 20 startups using iSafe, and that's where we are focused and with our mission to say we are funding simplified, and that's where what we believe, and that's why we created iSafe for Indian startups. Coming to how do you pitch across, right? So many of the times founders are not talking numbers, which I find it amusing, right? Most of them would say that dream, like we want to become the biggest security software. It does not have any value. The goal is to where you are specified saying that I would become like 100 million ARR in 3 years. Now something of that excites where you have a concrete goal and a vision, as precise, right? So how do you create a pitch, right? So many of the time we ask founders a simple formula to use across. So what? So let's say a founder comes and pitches across saying that I have built 128-bit security software. Now, for me, it doesn't mean anything. It is I ask them like, so what? So what? Right? So then he comes back saying that okay, I have built this software which is very difficult to crack and no hacker can come in. Then so what? Saying that okay, any data which you will transfer from your office to home, which will not get cracked across. So that's the amazing stuff, the way you now created a business out of your product, right? So when you talk across business instead of product, that is where investors get excited about. And avoid using adjectives, right? Give numbers, right? And numbers talk. uh, Pitching investor, remember that your goal is not to close the deal in one go, right? It takes multiple 7 meetings, as I said, across before you close across. So try to get the next meeting, right? Get those multiple meetings done across. And investor are looking across for moonshots, yes, the large dreams which they want to, but they would need to see some evidence saying that this is possible, right? So how do you ensure them and feed them with lots of data? Reasons. Now, this is very interesting. Couple of slides which are there before I end the session is going to be reason why startups don't get funded. Right? What are the reasons why would VCs not respond to you, or you will not hear from the VCs? Let's try and understand. One, if you are a company which is not VC investable, right? You are a great business. You might be making profits. You have sustained for 3 to 4 years. You build a great business, but venture capital would not be the right source for you. The market has to be very, very huge. So for venture capital to come into your business, there has to be really big price at the end of the journey. For example, I was an early investor in Oyo Rooms, Block.one. These are two unicorns in my portfolio. Recently, I had a great exit with a company called Loginext, where all investors made 16x return, which is out there in public. So people would like to see across great returns coming with great founders and companies. Now, there has to be huge amount of value creation which has to happen across at the exit kind of. So that's the key which can help across you get attractive investment propositions or hearing from VCs. uh, so one of the biggest problem in the pitch, right? You are meeting an entrepreneur, you are doing an elevator pitch, and as an entrepreneur you will fall in love with your product and you start talking all about your product, rather than talking about the business, how this is big, this is how you will make money. So first clearly define your value proposition, your elevator pitch. So yes, it's great to be in love with your product, but first you need to convert your product into a proper business, right? And then pitch to VCs. Lack of focus, right? This is one of the major problems what I see across with many of the founders. They would, when they come across, they will come with 3 products or 4 products, saying that I have this option, I have this option. That confuses investor, right? You don't know where this money is going to be used across. Or people talk about multiple revenue streams, saying that I can do one time sale, I will do subscription services also, and I have got a license sale also, and I've got a services business also. That lack of focus shuns away investors, because when there are so many possibilities, an investor is confused and he doesn't know how this capital is going to be deployed. Will it be deployed for building a services business? Will it be deployed across to build a product business? So what is going to be the focus, right? At seed stage, early stage, you need extreme focus, laser sharp focus on one product, one category, one revenue stream. And that's what will help across investors engagement and attention. Um, Many of the time, we have seen across founders coming with a very complex equity structure. There are companies which are subsidiary, and there are holding companies. Now at seed stage it's all confusing. You just need a simple private limited company with a clean cap table structure. It needs to be absolutely vanilla flavored, standard stuff where it is easy to invest into. There will be loans on the book. There are some promises which has been given across for advisors up to like 5%, 10% equity. Now these are all the things which scares the investors away. So keep your cap table clean, very clean, before you pitch to any of the investors. Taking advice from the wrong people. Now you are, as a founder, are vulnerable. You want to take advice from many people to figure out where and how you can raise money. And I've seen across personally, a lot of seed stage founders are gullible and fall for a lot of the advisors, so called, or their friends and family, who might not be thinking ill, but they don't have any clue how the VC investment works across. So you meet them, you show across how a VC investor works, an agreement. They will say, okay, this investor is going to buy you out. They've got so much right. You are giving away everything to the investors. No, the VC does not want to run business. If VCs were to run business, they can build their own company and do it. They are in business of investing, but to protect their investment, they will ask for rights. So whose advice you will take across is very important at the early stage. Please understand your investor who is going to come across will have to engage with your advisor equally. So find an advisor who knows his business, or find a mentor who knows the startup ecosystem well. Even many of the chartered accountants would not have any understanding on how this whole startup engagement, the valuations work across. So find right people who are there in the industry. Find the what is the best way to find the background of those companies. Check which are all other companies they have advised, and get the founder feedback, how good that advisor was, right? So take advice from the right people. uh, this is one of the very lovely slides which I like across, where we work very closely with founders now. Dhruvil, who is the founder of Loginext, right? This is and post which was outside. Once I had exited his company, I'm no longer a shareholder, and he posted this. So it gives you like huge feeling of gratitude. Kinnar, who is part of 100x, right? And we were spending a lot of time with all the founders of our class one. Nikhil, who is a Road Metrics founder. So these are great posts which are there as a gratitude, which you work with founders closely to help them build business, right? So we at 100x VC are open for class 2, which is the next set of startup which we are looking across. Please write to us at pitch at 100x.vc, and we look forward to engage with you guys. Thank you so much for your time and patience listening. Happy to We are continuously working out on the new seminars, and you please follow us on 100x Twitter handle at the rate 100x underscore VC. Subscribe to 100x YouTube channel, and you will see across more and more seminar and content coming your way. Thank you so much for your patience listening. Please write to us at pitch at 100x.vc. We have recently published a India Sentiment Outlook Survey report, which is available on 100x.vc website on the research page. Please go and download, use it across, share it across to the community. And thank you so much. Stay safe, stay home.